Most people who get blindsided by this don't see one problem coming. They see one problem, and they handle it. What they don't see are the two traps that were already open behind it. And the third one is the quiet one. The one that doesn't make noise. The one that just slowly empties the account, year after year, while you're sitting at home believing the hard part is behind you. If you've spent the last 20, 30 years stuffing money into a traditional 401k because that's what smart, responsible people do, this isn't a story about someone else. This is already your story. Before we start today's discussion, I want to say something. Most people charge a lot of money for this kind of retirement and money advice. But on this channel, I share it with you for free. So before we continue, make sure to subscribe. John had been an engineer for 33 years. Not flashy. Not careless. Every raise, every year-end bonus, every spare dollar he could move straight into the 401k. His wife Janet would sometimes say they should take a vacation, a real one, and John would say, after retirement, he had a plan. He was following it. He trusted it the way you trust the structure you helped build yourself. The night before his 73rd birthday, he sat down at the kitchen table with his coffee going cold and pulled up his account balance on his laptop. $1.2 million. He'd watched that number grow for 3 decades. The way some men are proud of their houses, or the things they built with their hands, John was proud of that number. It meant the plan had worked. Then his financial advisor called the next morning and said something John had never fully processed. John, you have to start taking withdrawals now. It's the law. Not can. Not should. Have to. At 73, the IRS requires you to begin taking what are called required minimum distributions, RMDs, from any traditional 401k or IRA you hold. It doesn't matter if you don't need the money. It doesn't matter if the market just dropped. It doesn't matter if every bill is already covered and the account is doing exactly what you want it to do. There is a clock built into every tax-deferred retirement account in America, and at 73, that clock runs out. The government wants its share, and it decides when you pay. John's first mandatory withdrawal came to roughly $45,000. Think about what that means for a second. Not $45,000 to spend freely. $45,000 of taxable income, added on top of his pension, on top of his Social Security, in a single calendar year. Taxed like a salary. Taxed at ordinary income rates. John looked at the number and thought, this is the problem. This is the thing I have to manage. He was wrong. That was only trap 1. Here's the part most people don't find out until they're already standing inside it. The moment that RMD lands on your income, it doesn't just create a tax bill. It pulls 2 other levers at the exact same time, and both of them were already attached to benefits you thought were untouchable. John's total income that first year, pension, Social Security, RMD combined, crossed a threshold he never heard of before. And once it crossed that line, the IRS began taxing 85% of his Social Security. He'd spent decades thinking of Social Security as a separate thing. Something earned. A check that was his. But Social Security is income tested once your combined earnings get high enough, and an RMD, especially from a 7-figure account, will push most couples straight over that line. What had been $2,400 a month from Social Security became, after taxes, closer to $1,700. That was uncomfortable. But it wasn't what broke the evening. 3 weeks later, Janet opened an envelope from Medicare while standing at the kitchen counter, still in her coat from running errands. She read it once. She read it again. Then she walked into the living room and handed it to John without saying a word. Their Medicare Part B premium was increasing. Not by a little. By hundreds of dollars, per person, per year, because their combined income had crossed what Medicare calls the IRMAA threshold. IRMAA is an income-related surcharge that most retirees have never heard of until it arrives in the mail. It activates automatically when your household income crosses a certain level. A large RMD from a large traditional account will trigger it almost every time. John and Janet were now paying an extra $4,700 per year for Medicare coverage they were already paying for. On top of the income tax on the RMD, on top of the taxation of their Social Security. John sat at that kitchen table for a long time. He'd handled Trap 1. He'd done what the law required. He hadn't noticed that solving Trap 1 had opened Trap 2 directly behind him. You might be thinking, all right, it's expensive, it stings, but the account is still there. You're still pulling money out. You'll adjust. The number is still big enough to absorb it. Hold that thought. Because here's what John hadn't seen yet. Every year that passes, the RMD grows larger. Not because the rules change. Because of how the formula works. The IRS calculates your required withdrawal by dividing your account balance by a life expectancy factor, and that factor shrinks each year. So even if the account earned nothing, a bigger percentage has to come out. And if the market performs well, which, over the long run, it usually does, both the balance and the RMD climb together. They compound upward. Toward you. John's RMD at 73 was $45,000. By age 80, running conservative growth projections, the same account could generate an RMD above $100,000 in a single year. Not investment gains, ordinary income. Taxed like a paycheck. And by that point, John and Janet would have been pushed back into the same tax bracket John occupied during his working career. The very thing deferring taxes was supposed to help him escape. That's Trap 3. Not 1 year of taxes. Not one Medicare surcharge. It's the relentless, compounding tax exposure across an entire decade of retirement. The slow, annual drain that turns a $1.2 million account into something that feels, in practice, much smaller than what the number suggests. Analysts who model this kind of scenario find that over a 15-year retirement window, households with large traditional accounts can lose well over $150,000 to taxes and surcharges. Money that was supposed to fund the life, pay for care, pass down to children. And the people this hits hardest are never the ones who were reckless. They're the ones who followed the plan exactly. There's a woman in this story too. Her name is Maria. She's 62, widowed, a school teacher who spent 30 years moving every spare dollar into her IRA while raising 2 kids by herself. No second income. No windfalls. Just discipline and sacrifice and the belief that the accounts would protect her. When Maria finally sat down with an accountant at 61 to map out her retirement, she walked in feeling secure. She didn't feel that way walking out. The accountant ran the projections. Maria's traditional IRA at retirement, just over $800,000. Social Security, $1,800 a month. On paper, stable. Comfortable. But here's what the projection showed in year 9. When the RMDs kicked in, every mandatory withdrawal would push her income past the IRMAA threshold automatically. 85% of her Social Security would become taxable, every single year. Her Medicare premiums would climb and stay up. And the inheritance she'd built, the thing that made 30 years of sacrifice feel like it meant something, would arrive at her children's door preloaded with a deferred IRS obligation they didn't know was coming. Her kids wouldn't inherit $800,000. They'd inherit a traditional IRA, which means they'd inherit a tax bill disguised as a gift. Maria sat in the parking lot for a long time after that appointment before she put the car in gear. There's one more layer here. And it doesn't show up on a tax return at all. When Trap 3 fully activates, when the RMDs are large, the bracket is high, and the surcharges are annual and growing, something shifts in how people live. Retirees with large traditional accounts start making a specific quiet calculation. They hold back. They hesitate before the vacation, before the home repair, before the grandchild's tuition. Not because the account is empty. Because the account doesn't feel free. $1.5 million feels wealthy. $1.5 million that generates $25,000 to $35,000 in annual taxes and surcharges. With that number climbing each year, that feels like something else entirely. It feels like running in place. It feels like the finish line keeps moving. And the couples who land here, who did every responsible thing they were ever told to do, a lot of them don't get angry. They get quiet. They build a smaller version of the retirement they planned. And they try not to think too hard about the space between what they imagined and what they're actually living. That's the cost nobody puts in the brochure. The people who avoid all three traps have one thing in common. They didn't wait until 73 to think about this. They started Roth conversions in their 50s or early 60s, gradually moving portions of their traditional accounts into Roth accounts, paying tax now at a manageable, controlled rate, before the RMD clock started running and before the government decided the amount and the timing for them. The goal was never to escape taxes entirely. The goal was to choose when and how much, rather than letting the IRS answer that question for them. Tax diversification, not putting every dollar into a tax-deferred account, keeping some in Roth, some in taxable accounts, is the thing that gives retirees flexibility. Without it, every financial decision in retirement runs through a tax lens that you can't fully control. If you're 55 and most of your retirement is sitting in a traditional 401k, the window is open. If you're 65, it's narrower, but it isn't closed. If you're already 70, there are still moves. But each year that goes by without addressing this, Trap 3 closes a little more. Most people will never read an IRS publication. Most people won't look up IRMAA thresholds. They'll do the obvious thing: save, defer, retire, and trust that following the conventional advice is the whole answer. It isn't. The system doesn't warn you about the traps stacked behind the first one. It just enforces them. Quietly, annually, permanently. And the part that stays with you, the part John thinks about now when he sits in that armchair at night, isn't the size of the tax bill. It's the realization that the problem was put in motion 30 years ago. By advice that was technically correct. Just incomplete. Trap 1 looks like a withdrawal notice. Trap 2 looks like a Medicare envelope. Trap 3 looks like the rest of your retirement. A number on a screen that's never quite as yours as you thought it was. If you thought the first trap, the RMD, was the real problem until I showed you what was stacked behind it, hit like. That's exactly the reaction this video was built to cause. In the comments, I want you to tell me which of the three traps would have caught you first, because the answer tells you something real about where your own plan might have a gap. And subscribe Henry Wealth Mindset, because next time we're going deeper into the traps people only discover after they're already inside them. And by that point, the cost of getting out is always higher than the cost of never going in.